Hey, what's up, everybody? It is Multifamily Unplugged Saturday morning. I hope that you are enjoying your weekend, no matter what you're doing, whether you are spending a little time catching up still on some work from the week, or if you're spending time with family or whatever you're doing. But I hope that you're being intentional about your time, right? We just had the summit a week or so ago, and we had 15 great speakers on. It was a great event, and we talked about a lot of different topics and ideas. Hopefully you drew a line in the sand if you were at the summit and decided to move forward and to do something, to take some action. I think that we can get this education, we can learn something, but unless we draw that line in the sand and we say, hey, right now I'm going to take action. And that's what I really hope you're intentional about, is taking action, taking the next step that's going to help you grow, help your business grow. We're going to learn some things today on today's episode that you might say, wow, I never heard that before. Or, I've heard that before, but I've never done anything with it. Maybe today's the day that you're going to decide, hey, I'm gonna take the next step. I'm going to take some action. Jim Rohn said that an idea is only as good as the action that you take after you've heard it. He went on to say that if you learn something new, it's only good if you take action on it. So, hey, what did you learn at the summit? What are you learning from listening in the podcasts on Saturday morning? Enough for you to take some action, to take the next step. Maybe it's you need to start some coaching. Maybe it's you need to underwrite some more deals. Maybe it's that you need to write another offer or change something in your management structure. Whatever it is, take some action though. Hey, if you're new to the show, I'm glad that you're here this morning. Thanks for tuning in. If you're listening in on YouTube, please smash the subscribe button. We're always bringing out new content relevant for your business to help your business grow, but more importantly, to help you grow personally. So follow us on social media, like us, love us, help us grow that following, please. And continue to tell somebody else about us, and tell somebody else about Saturday morning and Multifamily Unplugged and the new information, content, and speakers that you hear. So I'm excited about my guest today, John Ensley. John and I got connected through a mutual friend of ours, Margie, who does a lot of podcast connecting and has really sent me some great guests over the last year. And John's another one of those. John's from upstate New York. He's with his company is J-Ensley Financial. Let me bring him in and see what we're going to talk about today. John, good morning.
Good morning, Mike.
How are you?
I am awesome. Looking forward to this.
Good to see you. Yeah, I'm looking forward to it too. I always love having people on, and especially having people on that maybe I haven't met before, because now you build a new relationship, you get to meet somebody new. It's almost like going to a networking event,
Right.
So, hey, John, I always start my show though with one question. I always want to ask people, in one word, what best describes you both personally and professionally?
Yeah, that is such a great question. And the word I would use is independence. And let me share a little story about how I came up with that. Of course, I've been listening to your show, so I kind of knew that question was coming. And I did some work personally many years ago identifying core values. And the core values that came up for me were freedom, adventure, and service were my three top core values. And I was trying to find a word that kind of summed up those three core values. And so I scuttled over to ChatGPT and I asked it to give me some words that would encompass those three core values. And the one that immediately jumped out at me was independence.
Wow.
I think independence really sums up, me personally. I'm always trying to build more independence, more self-sufficiency, more self-reliance into my life. And I got into the financial planning business originally because I want to help other people create that in their lives. And the specific tools I use are really geared towards building more independence.
So first of all, I have to say, I think it's awesome that you went to Chat GPT and got that in. Right? That's kind of, I don't know if you're like me or not, but I use it a lot today. And, I'll type a question in and get an answer back, and I'll ask it again. And, it's almost like now you're having a conversation. It's pretty interesting tool.
Yeah, every day I seem to find some other little thing that I can use it for. I was working on a PowerPoint presentation for a webinar I have coming up, and was kind of stuck on a couple things. And I found an AI service that builds PowerPoint slides, and it filled in some blanks for me. It was great.
I think it's going to put Fiverr out of business.
Hopefully not. There'll be AI experts on Fiverr is what will happen.
Probably. Yeah, it's I use it to write content. I needed to craft an email to somebody that was just, a little different, and I used it to craft an email, So it's it's been an interesting tool to continue to use. So
yeah, for sure.
I remember I remember when I first I was watching 60 Minutes. This has got to be 5-6 years ago, and they had this episode on about AI, and I remember sitting there thinking, man, this is going to change the world.
Mm-hmm.
And and it wasn't like, oh my God, that'll never happen. It was like, we've seen all of these technological advances over the last several years. They say technology doubles every 2.5 years. But we've seen all these technology advances over the last few years. And when I sat there and watched that, I was like, man, that's just crazy. And
it is insane, the pace of technology. I was in high school in the 80s, and to think about the difference between then and now, it's amazing. The AI stuff kind of reminds me of when the internet first started going mainstream, and you could jump on a browser and search all kinds of information. It was just, I remember being boggled at how much information was out there. Any question you could put in there, and it would have pages of answers for you.
Well, what I think is really cool is you can go back and ask it the same. Could you expound on this, or answer this in a different way? Or I'll write something, and then I'll ask it to write something like, I could ask it to write something like you would write it, and it would come back in a way you write something, and I use it like, if I'll say, write it like Tony Robbins would write, and it's
That's
just
a great idea.
Interesting how it comes back. Just on this technology thing for a minute, because I'm fascinated by some of it. And you did have to go date me. So I gotta, you were in high school in the 80s. I was in high school in the 70s. So, but I remember it was my senior year of high school, and I was working at this place. And I remember one of the salesmen there who said to me, he goes, and this was just after the old brick cell phones came out. Remember the big cell phone almost took 2 hands to hold them up,
It had like a little suitcase for the battery.
Yeah, right. But I remember when and he said to me one day, this salesman, he goes, one of these days, this cell phone will be as big as a credit card, and it'll fit in your suit coat pocket. And I thought, I walked away from that conversation going, that guy's crazy. He doesn't know anything. They'll never be able to do that. But that's something I'll always remember, because, look from that point, how far we've changed, right?
It's amazing. Yeah.
In the 80s, do you remember fax machines?
Oh, exactly. Yes, for sure. Fax machines. And I always tell the story that my freshman year in high school, I took typing on electric typewriters, right? And then between my freshman and sophomore year, they converted the typing lab to Commodore 64s. And so my sophomore year, it was keyboarding, right? When they right there at that transition point. We live in interesting times.
That's funny. Well, why don't we talk a little bit about your history? We're already talking about high school. So
absolutely. So background, I got out of the Army in, excuse me, in 1992 and was in the right place at the right time and happened to go to work for a company that was a government contractor for the U.S. Department of Education collecting defaulted student loans. And at the time, of course, the tech bubble was beginning to inflate, and this company was going to do an IPO, and it was pretty exciting times as we built up into that 2000 timeframe. Unfortunately, the tech bubble burst. The IPO kind of got scrapped, and I moved on from that company. It was a great experience and taught me a ton of things. And I had a little money in an employee stock ownership plan when I left there, and I did some calculations and realized that I wasn't super happy with the tax exposure I may have down the road. So I took those funds out of that ESOP and invested in a real estate project in Southwest Washington State, which, by the way, in your intro, I'll make one quick correction. I am in Washington State, not upstate New York.
Okay. I said New York. I'm so sorry.
No, that's okay. So I had this property and subdivided it in a small subdivision, 5 lots, and the plan was to build spec homes. And by this time, we're into that early to mid 2000 time frame. And so, I had appraisals that made this project look like it was going to be amazing. And I was about halfway through the first spec home build when 2008 came along, and things started not working out so well. And it was a combination of the economic situation that was going on with real estate at the time and me not knowing what I was doing at that point in time and made some mistakes. But that whole experience, that project kind of imploded, didn't turn out very well. That whole experience was really a wake-up call for me. And I started reading and studying and absorbing and trying to educate myself in every way I could, mostly about finance, but also about life. And somewhere along the way, I was on a webinar and I heard an advisor talking about a cash value life insurance policy. He was mapping out some home equity for this couple. And it was my first exposure to the idea that life insurance could be something other than a death benefit, that it could have some other purpose. And so that led me to some books and resources. Somewhere during that presentation, he used the words infinite banking, and that kind of gave me a direction to go, finding some books and whatnot. And so I set up my own infinite banking type or bank on yourself type policy and used it a little bit and got very passionate about this idea. And I knew from all the advisors I'd been to over the years, nobody had ever mentioned anything like this to me before. So I know it wasn't really getting talked about out there. And so I was ready for a career change at the time and got licensed, got some training, and launched my financial planning practice in 2012, specifically to help people understand and implement these types of concepts.
Interesting. First of all, I just want to say thanks for your service.
Oh, absolutely.
So, for the layperson who doesn't understand what infinite banking is, let's explain that to them.
Absolutely. So I'll explain it the way I explain it. I know there's a bit of information online, but what it comes down to me, it's very simple. We all use what I call the banking equation, right? We're all saving, borrowing, and investing at some level somewhere. Everyone is using that system. And the systems we're familiar with include banks and credit card companies and so forth in that banking and credit operation. So what we're really doing is using the unique features of high cash value, low commission, dividend paying whole life insurance contracts to create a platform for saving, borrowing, and investing. And so in the simplest terms, we're building up a cash pool within that life insurance contract that we can then borrow from and repay and use it as a platform or a system for saving, borrowing, and investing.
Interesting. So I work with a lot of passive investors. I syndicate multifamily deals, and I'm raising capital all the time and bringing passive investors into deals to share in the profits.
Mm-hmm.
So let's talk, and you understand that, I think, from
Yes.
your experience and investing knowledge in that. How does that work the with this product, with infinite banking?
So I think probably the best way to talk about that is to tell a story, if that's okay.
Yeah,
So
stories.
okay, perfect. So I have a client that I'll leave him anonymous, but we'll talk about his situation. He's been funding policies, infinite banking type policies, for a number of years. He's done a number of things with it in terms of his own personal real estate, moving a couple of times and using the policy as a source of financing, either for down payments and so forth. But here recently, he actually got into 2 syndication deals, and he used his policies to fund the upfront cash on both of those. And I helped him map that out. So he basically, from the policy, he took policy loans, and that's what got him into these syndication deals. The cash flow that's coming, it's a 7-year, both of them are 7-year deals, and it's as the cash flow that's coming in off of those properties to him every year, he's going to use those to pay down the policy loans that he took from his policy. And then at the end, when it refinances or sells or whatever they do with it at the end, when he gets cashed out, he'll pay the rest of the policy loan off, and then he's got his profit, which he'll drive back into the policies in the form of new premium to drive his cash values up even higher, and then rinse and repeat. He's going to look for those opportunities over and over and over again and use the policies as that funding source. Now, the way it's working out over the 7-year period, he's paying those policies down. His effective annual interest rate, I'll call it, is just under 4%, based on the current rates within the policy. So it's super attractive financing right now in particular. And then, of course, there's a death benefit. It's life insurance. So if we get 3 years or 4 years into this deal and something happens to him and he's dead, then that death benefit comes in, and it's going to make his wife and his family whole and complete that investment for him. So this is why I refer to it as a system for saving, borrowing, and investing. He's been saving into these policies for years and years. He's used them to borrow against many times, and in the current project, he's doing some syndication. Passive syndication deals, and then eventually, when he decides he doesn't want to actively do things, he may never decide that, but if he does, then we can take these cash values and also create a passive income stream from the cash value in the policy later in life too. So there's a whole lot going there that makes these kind of an appealing approach.
So, I've had a few infinite banking people on my show over the last few years, and I always have a myriad of questions. And I think that, just from this conversation today, I have a whole bunch of questions that you've kind of sparked in me. So one of the first ones is, how much money do you need to get started in this process?
That's a great question. And I'll start off by saying the accumulation of cash value in the policy is directly related to how much you put in the policy when. So there's really 2 approaches. The vast majority of people build these policies up over time. So they're putting X amount of dollars in per month or per year over a period of time. That's the gentleman that I was just talking about. That's basically what he has done. He's funded that policy over quite a few years. The other option is you can take a lump sum, a large amount, and put it in the policy on day one, and the policy can be designed to accommodate that large premium. So there's a range of if you're young or just getting started or just getting back on your feet after a setback or something like that, you can really start as small as you need to. I typically tell folks that somewhere around $500 a month is sort of the lower limit. You can design a policy less than that, but it's going to take some time before it really builds up any meaningful usable cash value. So anywhere from that, say $500 monthly, $6,000 per year, is the amount of death benefit that a life insurance company will issue on a single life. So millions can be put into these policies on an annual basis, and everything in between.
And if I'm putting in 500 a month, and I obviously I'm not starting with $1 million death benefit at 500 a month in the policy. As that grows, can I increase my death benefit?
Actually, the way these are designed, that death benefit's going to increase automatically. So the way I like to describe this is every dollar you put in the policy is buying death benefit. And I don't want to get lost in the weeds with the technical, how it's structured, but there's some riders, and we're going to structure those riders in the right ratio. So that 5,000 is going to be divided between a few different things, a base policy and some riders. And how we do that will determine how much cash value builds up how quickly. And so that cash value is a derivative of the amount that you're putting in on the front end that's going into the policy either monthly or annually.
Okay.
And so the death benefit every year when we pay that premium, we're buying more death benefit. So every year, both the cash value and the death benefit are going to increase by a larger amount.
Okay. Age restrictions or limits?
So most companies have products that they can maybe go up to about age 85. Is kind of where you start finding very few products that go beyond that. And I think, realistically, the sooner the better, right? The old proverb, the best time to plant a tree was 20 years ago, but the second best time is today. So the sooner the better, obviously. But yes, the policies can really go up to about that 85 age. And obviously, I think over age 70, it starts getting much more limited and much more nuanced.
So let's say that, somebody's in their mid 60s and they want to start to fund one of these things. And they could actually start to fund one of these with $500 a month.
They could, yes. And I would say the majority of the folks that come through my office are probably in that 55 to 65 range. So this is not uncommon at all for someone in their 60s, for instance, to get a policy started. And of course, all of it comes down to individual goals and objectives, right? What do they want to accomplish? What resources do they have in order to design the policy? So certainly they could start one at $500 a month, and that may or may not make sense based on what they want that to do.
Sure. Now there's the person that might have 50 or 100 or $1 million and could fund the policy day one. And if that happens, and then they want to use their money to go invest in a syndication, how quickly can they turn around and use their money?
Really very quickly. As soon as the policy is issued, a significant portion of that initial amount would be available to borrow against the policy. So a story I like to tell a lot, at a young guy that was in the military, and he was overseas and he saved up quite a bit of money, a pretty good lump sum. And when he came back is when I met him, and we put together a policy that he put $100,000 initial lump sum into this policy. And he had also, when he got back from being overseas, he bought himself a Tesla and he financed it right through the bank. So literally the day after the policy issued, we submitted the forms, and he borrowed about $80,000 back out of the policy the day after it was issued and paid off the Tesla. And then of course paid himself back through the policy. He is now using that policy to fund rental properties and so forth.
Does he still have the Tesla?
I didn't ask the last time I had a review meeting with him, but I think he does.
That's funny. So if I have $100,000 and I pull out, you could pull out, it sounds like 80% of it to invest somewhere.
That's a good ballpark. That's going to range depending on the exact situation and design. But yeah, 80% is a pretty good ballpark.
Okay. So if I pull 80% out, that gives me 80,000 to invest in a syndication, and then I have to pay myself a 4% interest on that 80,000.
So, sort of. Let me explain that a little bit.
Okay.
So I know I mentioned my client who's doing the syndication. I said it worked out to 4% his effective annual rate. So when we take a policy loan on these policies, what's really happening is the life insurance company is highly regulated in what they can invest in. So they invest in highly rated corporate bonds, government bonds, mortgages, things of this nature. And one of the investments that the regulators like for an insurance company is policy loans to their own policy owners for a mutual company. And so a life insurance company can make a loan as an investment to their own policy owners. And when they do that, what they're doing is they're using the policy as the collateral. So a cash value in the policy is the limit of what you can borrow from the insurance company. And they're using the death benefit as the collateral on that loan. And so it creates kind of a unique situation in that the insurance company is secure with the death benefit. If you never pay the loan back and you die, then the loan and interest will get offset from the death benefit, and that's it. So because of that, as the policy owner, you're in complete control of how you repay the loan. So first of all, it's no qualifying. There's no application. There's no income verification. You just fill out a form and they direct deposit the money. The only qualification is that you have cash value in the policy. Secondly, it's a no recourse loan. So whatever you used that financing for is not encumbered, or it's not collateralized. The only thing that's collateralized is the policy. And so how this relates to interest rate is the insurance company is going to charge an interest rate because it's an investment for them. And most companies are somewhere in the 5% range right now, but it's a simple rate and it's applied once per year on the anniversary date of the policy. And when you make your payments, you're not paying interest, you're paying the principal down dollar for dollar. And then the interest is applied by being capitalized into the balance on the anniversary date every year. And that's a very complicated mix of things to say that the quicker you pay down the loan, the lower your effective annual rate will be. So if you pay that loan off in, let's say, 4 to 5 years, and you do the math, the effective rate works out typically in the 2% range, 1.8 to 2.2. If you extend that out to 10 years, then that rate might end up in the 3.5% range, even though the stated rate is 5. And the effective rate is what I was referring to. So the gentleman that I mentioned that's doing the syndication deal, his effective rate based on this rate, how fast he's paying that loan down, is going to work out to right around just under 4%.
Interesting. So am I required, like in a self-directed IRA, I'm required any earnings from the investment have to go back in the IRA? Is it the same thing in this type of a policy? Any earnings? So if I'm getting a preferred return on that property of, call it 7%, do I have to put that back in the policy to pay down the loan or to make the balance grow? Or is that my choice then?
That is your choice. I think that's one of the advantages to one of these types of policies as compared to self-directed IRAs. The self-directed IRA gives you the tax advantage on one side, but on the other side, it has a lot of restrictions like what you're referring to. The money has to stay in the self-directed IRA, and you have to worry about self-dealing and some of those kinds of things to make sure you don't cross those lines. With the policy, you really can do whatever you want with it. And whatever you make on that project doesn't have to go. I mentioned, the gentleman we were talking about will take the profit and put it back in the policy as new premium, drive the cash value higher so that he can then use those in the future. But he could take that profit and do anything he wanted with it.
Man, I love this. Every time I hear this, I love this more and more because it makes more sense. This is probably the 4th or 5th time now that I've gone through this with somebody, and it makes more and more sense. How about depreciation? So we know in real estate, there's this magical gift, one of the last gifts the government gives us, right? And it's depreciation. And so if I get a K1 at the end of the year and it's got depreciation on it, and but I borrowed the money from the life insurance policy, invested that money, am I allowed to use that depreciation anywhere on my taxes to lower my taxable income?
Yeah, you could use that like you would any other lending source. The thing that I would caution everyone is to get an accountant involved, work with your CPA, make sure it's structured and reported to the IRS correctly so that you can take advantage of those tax advantages. There's a whole host of tax advantages to use this kind of financing. But again, work with a CPA or an accountant to make sure it's all set up the right way so you can maximize it.
One of the things I really like to do with my investors is work with them on tax strategies and financial planning strategies. You know, how do we, and I try to fill 3 buckets for my passive investor, right? Cash flow, long-term wealth, and tax planning, right? That I think that gives a well-rounded real estate deal to investors. And you know, there's markets, and I'm really market driven. So there's markets where you're going to get cash flow or you're going to get appreciation, but I want to be in markets I'm getting all 3. And this sounds like a great vehicle that would help people on the tax planning side also.
Yeah, for sure. There are, you know, a CPA who's written quite a few books, Ed Slott. You may have heard of Ed Slott, but he often talks about that the IRS code that talks about life insurance, which is Section 7702, is probably the most misunderstood and underutilized code, you know, a section of the whole code. So life insurance comes with some unique tax advantages all on its own, aside from how borrowing from the policy can create some additional tax advantages for when you're in a business or as an investor. So I love the policies because it really touches on all 3 things you just mentioned. You know, when we are putting the money in after tax, and so it's growing tax deferred. So as the money is growing in the policy, that's all growing tax deferred. And when we access loans from the policy, those loans are under current tax law. Those loans are tax free. And we can also make, they're called surrenders, but it's kind of like a withdrawal from the policy. And we can make those tax free up to the basis. So from a cash flow, long-term wealth, tax planning strategy, this one tool accomplishes a lot of things. So we have this policy where the equity is going to increase by a larger amount, right? That sounds a lot like compounding. It's going to increase by a larger amount every year for the rest of your life, right? So there's our long-term wealth building, and it's got a death benefit at the end, which is also typically a tax-free transfer of wealth to the next generation. So we have that whole thing.
Why does not everybody know about this?
Well, I mentioned that I started my practice for that very question, was how could I have seen, you know, I had kind of these failures in my life related to some of the economic situations that I was living through at that time. How could I never have heard anything like this from all these advisors that I had spoken to over the years? And that's really what it is. I think the modern financial planning apparatus it's kind of geared towards one thing. And that is, you know, you save your money, you put it in the market, and you let it grow over time. Not that that's a bad strategy, but there are other strategies, and most planners and most financial services professionals just either aren't educated about those alternative strategies and aren't talking to their clients about it. So it's really just in the last few years that it started to go mainstream with books like Bank on Yourself by Pamela Yellen. You know, it's started to get more mainstream. More people are becoming familiar with it. And, you know, hopefully it's moving in the right direction. But that was my motivation for starting this practice, was to share this idea with people. And if it's a fit, help them implement it.
And the insurance behind it is AAA rated companies, and it's not, they're not lower quality insurance providers.
So there are providers across the ratings category. in the whole life insurance area that could probably put these policies together. The typical advisor, like myself, for instance, will only work with the top-rated companies that have over 100 years of history behind them. They're A-rated, and I'm looking for companies that are mutual, that are super conservative financially. They're not playing games with their reserves, those kinds of things.
So one thing I think people really need to understand too is they can't just go to their local insurance broker and do a whole life policy and expect to be able to do this. There's a whole process behind this, if I'm correct, right?
Yes, absolutely. I think there's a potential to be deeply disappointed in the result if you don't work with an advisor that knows how to structure the policy correctly. I mentioned the various riders and getting those structured within the IRS rules for life insurance. So there's a very specific way to put policies together. And if someone hasn't been educated in that, you'll either end up with, I run into people all the time that have think they have whole life policies, but it turns out they have some other type that someone pretty much convinced them was the same thing, but it's not. And so it's either designed wrong or you end up with the wrong product altogether. And over time, you'll end up kind of having some disappointing results.
And are you licensed? Do you have to be licensed as an insurance broker to offer this product? Or?
For sure, yes. You'd have to have an insurance license for whatever state that you're working in. Yeah, absolutely.
So you're in Washington. Could you sell me that policy? I live in Illinois.
Yes, absolutely. I can work in any state in the United States. I'm mostly, because I'm located in Washington, I think most of my licenses right now are on the western part of the U.S., but I do have clients in Virginia, Maryland, Texas, kind of all over the country. So once most people don't realize this, once you secure a resident license in your home state, so I'm a resident licensed agent, life insurance agent in Washington State, then there's the National Association of Insurance Commissioners has kind of a system set up that will allow you to secure a non-resident license in virtually any state. And so they have a system that kind of talks to itself. So if you've met the background and all the information for one state, you typically can pick up a non-resident license in another state pretty easily.
Okay, interesting. Well, listen, it's been very informative today. Is there anything that you'd like to leave the listeners with or like them to think about that would maybe drive them towards utilizing this?
Yeah, absolutely. One of the things I talk a lot about is understanding in our world, we're bombarded with marketing messages. And if you go online and you type in infinite banking or bank on yourself or whole life insurance, you're going to get a whole myriad of information, some of it positive about it, some of it negative about it. The thing I always stress is don't give in to the marketing messages, right? Have a conversation with someone, look at how this works. Don't let someone pressure you into something. Work with someone that's going to educate you. That's kind of the promise I make to people that come through my door, is I'm not here to sell you a product. I'm here to educate you about a concept. And if that concept fits your life and your goals and your objectives and what you want to accomplish, then I'm here to help you implement that. But I'm not here to shove anything down your throat or pressure you into buying some kind of product. That's not what I'm here for. So have a conversation with someone that is going to listen to you and understand your goals and objectives, and then help you decide whether this is the right fit or not.
Interesting. Well, listen, John, thanks for being here today. How do you want people to reach out to you and get a hold of you if they want more information or more knowledge?
For sure. So I have a page set up at jumponwithjohn, JOHN, and what that'll be is a page there where you can secure a 30-minute free strategy session in my calendar, so we can have that conversation I was just mentioning and see if this is a fit for you or not.
And I love that. I think I'm going to go set a page up, hook up with Mike. I love that. So everybody, hey, listen, reach out to John, get more information. If you're somebody who's thinking about some investing strategies, some tax planning strategies, definitely get more information on this. it just makes so much sense. If you have $50,000 or $100,000 that you're going to invest in a syndication, why not get some life insurance? Why not invest that money into the syndication and get some money and grow your future wealth? I think one of the big things, and this is just real quick, one of the big things I think people do is you'll get an investor who invests $25,000, $50,000 in a syndication, and they get a preferred return on an annual basis. Maybe they get, paid out quarterly, and on, on a 7% return on a $25,000 investment, every quarter you get $375, and you go, oh, look, $375. Let's go out for the weekend. Let's have a barbecue. Let's, and they don't save that money. And I believe that there needs to be, and I tell my investors all the time, save that money, because what will happen is you get to the end of that 3, 5, 7-year syndication and you go, where's all my money? Well, you spent, a few $1,000s along the way, because every quarter you took $375 and had extra beer money, and so, now I think this would be a great place for people to be able to have a more wealth. One last question. What if I never do anything with the money? What if I put it in there? I got a cash value in there. How does my cash value grow?
So it's, as I mentioned, it's going to grow by a larger amount every year. And so there's a couple of things that are happening within the policy. So it's actually quite common for someone to fund a policy for 10 years and then stop putting premium in, or 5 years or 7 years or whatever that is. But they fund it for a period of time and then stop. And so the policy is going to continue to grow even though there's no more premium coming in, because there's whole life insurance has an actuarial guaranteed growth that's just going to happen within the way the contract works, and it gets larger every year. And then there's dividends. So we work with mutual companies. They pay out dividends. They're not guaranteed, but they're paid when the policy performs better than expected. The companies that we were talking about earlier have paid a single year for over 100 years. That's one of the things we're looking for, is that history, where they in other words, they've performed better than expected every single year for over 100 years. So super stable companies. And so these dividends, when they come into the policy, the way there's a couple of options, but the way we set them up is that they're going to buy more insurance. And that's part of what drives that death benefit and that cash value higher is the growth, and the dividends are increasing both of those within the policy. So your cash value is just going to keep getting bigger and bigger and bigger and bigger for the rest of your life, but so is your death benefit. And so the way to think about that is you have this growing pool of cash value that you have access to while you're still alive. And it is a component of the death benefit, which is what your heirs are receiving if and when you die. Well, not if, when.
Well, I like if better.
If sounds more warm and fuzzy, but
Thanks for being here today. I appreciate it. You've enlightened my world. I'm sure that you have for my listeners too. And I just encourage people to reach out to you, connect, get some more information, and see how this works into your personal investing strategy, your portfolio. I think some of the other good things about this is that there's not some restrictions that you might have in an IRA, where in an IRA, you can't invest in certain markets or certain products, or you can't use the money. We talked early on about a guy that had the ability to invest in his own personal residence. So,
yeah, and that comes back to where we started with independence. That's one of the things I love about this concept, is it's independent from a lot of those systems that put those restrictions on us.
Awesome. Well, John, thanks for being here. You have a great weekend, and we will look forward to catching up with you again soon.
Thanks so much for having me on, Mike. Have a great